You pull $80,000 from a $2 million traditional 401k. Stack that on top of Social Security, and the IRS can include up to 85% of that benefit in your taxable income. Federal income tax bill, roughly $12,000. Medicare. Part B, another $2,400 a year, taken from your Social Security check before you see it. State income tax, more depending on where you live. Then the year the market falls 15%, and you sell shares at the bottom just to pay the bills. That is not one hit. That is 4. And everyone runs again next year until you change the structure. The retirement calculator showed $80,000. After those 4 forces, more than $14,000 is gone before you make a spending decision. The number that actually works for your expenses is closer to $65,000, and it shrinks when the market weighs in. Before your required minimum distributions start, there is a limited window to cut that tax bill permanently. Most people do not know exactly when it closes. I am your CFO next door. In the next 15 minutes, the step-by-step math on that $14,000 gap, the Medicare income cliff, sequence risk, and how to use that window before it shuts. Before Part 1, quick favor, if a plain English breakdown like this is useful to you, tap like and subscribe now so the next one finds you automatically. Part 1. Rarer than you think. EBRI, the Employee Benefit Research Institute, puts the share of U.S. households with 2 million or more in dedicated retirement accounts at approximately 1.8%. If you are near that level, you have done something that 98 out of 100 Americans never will. But here is what that number also tells you. 2 million became the default retirement target through one calculation. 2 million times 4% equals $80,000 a year. That math is correct. The 4% rule emerged from U.S. historical data covering roughly 7 decades of market returns, tested against 30-year retirement periods for diversified stock and bond portfolios, with withdrawals measured at the gross level before taxes. It is also a gross number, a before tax, before Medicare, before the market does something. Unexpected number. The gap between the gross and the net is the entire subject of this video. Part 2. The step-by-step math. Let's build this in front of you. You are 68 years old, filing single, and you have a $2 million traditional 401k. On January 2nd, you pull 4%, $80,000. Here is what happens next. Federal income tax. Every dollar from a traditional 401k or IRA is ordinary income. The IRS treats it the same as a paycheck. At 68 and filing single, your 2026 standard deduction is approximately $18,150. That is the base standard deduction of $16,100, plus an additional $2,050 for being 65 or older. There is also a new senior bonus deduction from the 2025 tax law, up to $6,000 for anyone 65 or older, available through 2028. It phases out once your income passes $75,000 and disappears completely above $175,000. At your income level in this base case, that adds another $5,700 of deduction. After both deductions, your taxable income is roughly $56,150. You run through the 10% and 12% brackets, then into the 22% bracket for the upper slice. The federal tax on that amount is approximately $7,100. That is the base case with no other income. But most retirees with $2 million also receive Social Security. Assume a benefit of roughly $24,000 a year, close to the current average monthly benefit for someone who retired at 67 after a moderate career. When you add that $24,000 to your portfolio income, the IRS uses a formula called provisional income. Provisional income is your adjusted gross income, $80,000, plus half your Social Security benefit, $12,000, for a combined total of $92,000. For a single filer, Once provisional income clears $34,000, up to 85% of the Social Security benefit can become taxable. That does not mean Social Security is taxed at an 85% rate. It means up to 85% of the benefit amount gets added to your taxable income. 85% of $24,000 is $20,400. That amount layers on top of your taxable income. At this higher combined income, the senior bonus deduction shrinks to about $4,500 because of the phase-out. But your federal tax bill still jumps from roughly $7,100 to approximately $11,800. Medicare Part B. The 2026 standard monthly premium is $202.90. 12 months. That is $2,435 per year, taken directly from your Social Security check before it arrives. Running total. Federal income tax on your combined retirement income, approximately $11,800. Medicare. Part B, $2,435, deducted from your Social Security check before it arrives, not from the 401k directly, but money that does not reach you regardless. Together, more than $14,200 consumed before you write a single check. After federal taxes and Medicare, the effective spending power from your planned $80,000 withdrawal comes to approximately $65,700 before state income taxes, before Part D, before anything else. In states that still fully tax 401k and IRA withdrawals, the number drops further. The plan said $80,000. The tax code and Medicare deliver something closer to $65,700. That gap runs every year, not once. The check the calculator showed has 4 silent cosigners. 2 of them have government addresses. Part 3. 3 forces pushing the number even lower. Most people see the federal tax math and decide they will plan around it. The problem is 3 additional forces that standard retirement calculators rarely model. Force 1. The IRMAA cliff. Medicare calculates your Part B and Part D premiums using your income from 2 years ago. That 2-year look-back is a mechanism almost nobody explains before you run into it. In 2026, if your modified adjusted gross income from 2024, your adjusted gross income plus any tax-exempt interest, was above $109,000 as a single filer, your Part B premium jumps from $202.90 to $284.10 per month. That is approximately $975 more per year. And the cliff is all or nothing. $1 over the line triggers the full surcharge for the entire year. A $2 million 401k generating $80,000 in withdrawals, plus Social Security income, plus any dividends or interest from a taxable account. It does not take much for that combined figure to cross $109,000. When it does, the surcharge appears 2 years later, for income you earned when Medicare surcharges may have been the last thing on your mind. Force 2. Sequence of returns. 2 retirees, same $2 million starting portfolio, same 4% withdrawal plan. One retires the year the market gains 15%. The other retires the year it falls 15%. 25 years later, even with identical average annual returns over the full period, the second retiree faces a materially different picture. Shorter portfolio life, fewer years of full spending. This is sequence of returns risk. When you are pulling money out every month, early losses are not symmetric with early gains. You sell shares at the low point to fund withdrawals. Those shares are gone. They cannot participate in the recovery you are waiting for because you already spent them. The 4% rule was calibrated to survive the worst historical sequences on record. What it cannot control is whether the retiree stays the course through a prolonged downturn or raises withdrawals when anxiety peaks. Force 3. The pre-tax assumption. The 4% rule was built on research that measured portfolio survival in gross terms, not after-tax survival. It assumes the full withdrawal is available to spend. As Part 2 showed, every dollar from a traditional account passes through ordinary income taxation first. The effective net withdrawal is meaningfully lower than the gross number that the calculator displays. Planning on the gross and spending to the gross is where the plan quietly goes wrong. Part 4. 3 moves that change the math permanently. These are not investment picks. They are account type and timing decisions, and the window to execute them is usually the years between your last day of work and the start of required minimum distributions. Move 1. Roth conversions while the window is open. Required minimum distributions begin at age 73 if you were born between 1951 and 1959, and at age 75 if you were born in 1960 or later. The years between retirement and that RMD start date are often the lowest taxable income window of the entire retirement. Many retirees have not yet claimed Social Security, have no pension, and are drawing only modestly from savings. The tax rate may be lower than it will ever be again. In those years, you can convert traditional IRA or 401k dollars into a Roth IRA. The converted amount counts as ordinary income in the year you execute it, which is why sizing the conversion carefully matters, because too large a conversion can itself trigger higher Medicare premiums or pull more of your Social Security benefit into the taxable range. But qualified Roth withdrawals afterward are tax-free and do not count toward provisional income, which means they do not pull more of your Social Security into the taxable range, and qualified Roth RA withdrawals do not count toward your MAGI for Medicare's IRMAA calculation. The approach is not to convert everything at once. Convert only enough each year to fill the available space in your current bracket without crossing the provisional income thresholds or the IRMAA cliff. A qualified fee-only fiduciary can calculate that number precisely. The principle: every dollar repositioned from taxable to tax-free before RMDs force. The issue is a dollar that no longer triggers the compounding tax hits we covered in Part 3. Move 2. 2 years of cash outside the portfolio. The sequence of returns problem has a practical defense. Keep roughly 2 years of living expenses in cash or short-term instruments, completely separate from the investment portfolio. When the market drops and your portfolio value falls, you draw from the cash reserve instead of selling depressed shares. 2 years gives the portfolio time to stabilize and begin recovering before you have to touch it again. It does not eliminate sequence risk entirely, but it absorbs the most damaging phase, the first year or two of forced sales at the bottom of a bear market, the sales that permanently reduce the portfolio's capacity to recover. Move 3. A flexible withdrawal rate. The 4% rule is a starting point, not a contract. A guardrails approach sets a starting withdrawal rate alongside upper and lower thresholds. When markets run well, you can draw a bit more. When they fall, you reduce spending by roughly 10% for that year, not permanently, just for that year, rather than taking the same dollar amount from a shrunken portfolio. Research on dynamic withdrawal approaches suggests that a flexible starting rate above 4% can hold up over a long retirement, when the discipline to actually reduce spending in a down year is real, not just a plan written in a good year. If markets fall and you do not cut, if anxiety says draw the same amount anyway, the flexibility is gone, and so is the benefit. The retirees who make $2 million work are not the ones who pick the right stocks. They are the ones who understood the difference between the gross number and the net number, managed their account types before the IRS forced the conversation, and built a spending plan that could absorb one bad year without derailing the whole plan. Here is the one-sentence version of everything we covered. $2 million at 4% is $80,000 in gross income from a traditional account, and roughly $65,000 or less in net spending after federal income taxes and Medicare premiums, with more taken in states that tax retirement income. Planning for the net, not the gross, is the work. Roth conversions before RMDs begin, a 2-year cash cushion against bad sequences, and a spending plan that bends without breaking. Those are the 3 moves that protect the net. This is not financial advice. Every tax situation is different. Every state handles retirement income differently, and nothing in this video replaces a conversation with a qualified fiduciary who knows your full picture. If this gave you a number worth running, hit like so this reaches more people your age who need to see this math. Subscribe to the CFO Next Door. These breakdowns come out regularly, and the next one is already in the works. And in the comments, drop the word math if you want more videos on what your retirement income actually nets once the tax code is done with it. See you next time.